see whether or not any of them can outperform given the kind of start we're headed to.
All right, Matt Orton is Chief Market Strategist at Raymond James Investment Management. He's joining us now to take some questions. Matt, great to have you with us here. Thank you very much. The worry is that the process of disinflation itself is decelerating with data coming in strong. As I was saying, what market pricing is of where the Fed terminal rate will be, that itself has moved up some 40 basis points in February so far alone. What's your sense, Matt? Are we going to go through another sort of meaningful risk-off phase for global equities?
Hey, good morning, Prashant. And I think this process that we're seeing is perfectly normal. Last time I was on, we talked about the need to have a normalization between the markets and what the Fed has been telling us for quite some time, that rates are, in fact, going to remain higher for longer. And we're seeing that play out. It's an encouraging sign that the data has held up remarkably well, much better than I think a lot of economists had expected. So it does point to that softer landing type of scenario. But the equity markets, particularly in the US this year, just moved too far too quickly, particularly in the higher duration parts of the market. So when you have this rapid adjustment in fixed income, we finally have the terminal rate pricing around where the dots have set. You've had rate cuts pretty much eliminated from the forecast for 2023, although there's still a little bit more room to go. That process should be impacting the equity markets, and we're finally seeing that play out. And that's why when I talk to a lot of our clients, I've been recommending to remain more defensive in positioning, leaning into higher quality companies with free cash flow, earnings stability, because we're still in a process of, I'd say, mediocre earnings, not a disaster, not fantastic. So you want to own companies that are still able to grow their earnings and where there's some stability. So I think this normalization process is still going to play out for a little while longer. But we need it to happen in order to have stable footing for the market to sustainably move higher.
Matt, good morning. The big headline globally is Walmart talking about just a 2 to 2.5% growth next year, right? I mean, when the world's largest retailer talks about such slow growth, you wonder what the rest of the world would do. Does that drop a bit of a concern for you, especially in the consumption space? And if yes, what would the reading be for the rest of the globe?
So, Sonia, I don't think Walmart missed expectations that tremendously. It's not encouraging to only see 2 to 2.5%. But the flip side of that is, I think when we were coming into this year, in November, December, expectations were for a much more material deceleration with respect to the American consumer, and we're not seeing that happen. So the fact that they're still able to grow, you're still seeing higher income consumers trade down, maybe use their grocery a little bit more, that'll negatively impact their earnings and margins as well. I still think it's okay. And what's even more important, when you look at the higher end of the US economy too, you had some more luxury home builders who you would have thought would be under pressure because of the significant rate rises. You actually saw them report really good earnings and strong guidance. So it's a mixed signal. I'd say the U.S. consumer is going to be a tale of two cities, but the fact that people still continue to consume, I think supports the idea that we can, in fact, have nominal growth. And that, to me, is what's most important to kind of preserve that softish landing thesis.
All right. Hi, Matt. Good morning. Nigel on this side. Matt, I believe that emerging markets, they find preference in your pecking list. That's ex-China. And a few of those markets have done well. Indonesia, Taiwan, Kospi, they've done fairly well. India has not really performed. So where does India come in this pecking order of emerging markets? And do you believe that if the global markets get a little bit jittery, we haven't participated in the party so far, but can we relatively outperform?
Yeah, that's a really, really good point. And India in particular has lagged the broader EM complex, but it comes on the heels a really, really strong outperformance last year. So again, it makes sense to see that happen. It also makes sense in the context of the Chinese reopening theme, where I think a lot of money that hadn't gone to China had moved into India. You saw that change earlier this year with very significant gains in China, and you're seeing it unwind a little bit. You're seeing more foreign investors start to invest back in India. So I think it's a normal give and take. But what I like about India is it's a little bit more insulated from the global economic narrative. GDP growth is still incredibly strong. I think there's the room for margin expansion in IT and IT services in particular, net interest margin expansion in some of the banks and financials. So I think the setup for the Indian market is positive, and I like it, especially given that it's a relative beneficiary of some of the weakness in China that I would expect to play out a little bit going forward. And that's also why I continue to prefer Asia ex-China on the EM complex, because, again, you have the ability for more earnings expansion that's not tied to some of the regulatory risks of China, as well as more of the hot money that had flown in over the past couple of months.
Okay, so continue to prefer Asia ex of China. So within the Asian basket, would you be raising your allocation to a market like India? Would it be status quo? Would you raise your cash levels? What's the best strategy now?
I think it's status quo, Sonia, because there's still some news flow. There's still news flow related to Adani Enterprises. I think I want to let the dust settle still a little bit more, but I'm looking for opportunities in India, say more than China and more than Latin America right now. I'd say India and kind of Southeast Asia are at the top of my emerging market list, simply because they have lagged the broader EM complex, and they're a little bit more insulated from some of these negative headwinds that are coming from the US right now.
All right, Matt, pleasure speaking with you. Thanks a lot for joining in. That is the Chief Market Strategist at Raymond James, saying that rates will stay higher for longer. They recommend to remain more defensive in the market now because of all the challenges that we're seeing globally. Let's slip into a quick break. Our entire team will be with us to help us with the top 10 stocks in just a bit. Stay tuned.